This is going to be a working lunch, so we'll get started. I just wanted to thank everybody for being here today. Got a big crowd, a lot of new faces. I'm learning the names, but we're grateful that Kate Gregory has brought you into the fold. So we're glad you're here. She'll come up in just a minute to address her clients, but I thought what I'd do is just take a minute and give you the background of RAI Wealth Management as well as Gregory Advisors and how it came to be to where it is today. So back in the day, 1992, we formed Ritchie Advisors Inc., and that's where the RAI comes from. Myself, Norm Credit, Jay Ritchie, and then in 2010, I looked it up, Terry, you joined us, and it was a great team. And then in a parallel universe was Gregory Advisors. We actually knew Ted and Kate because we both utilize SEI Private Trust Company, so we would run into each other at their educational forums. And Jay and Ted kind of had a bromance of sorts, so they were hanging out at those meetings. And this is where we are today with the new team, and we have our newest member, Angel Mendez. We plucked him right out of college, Cal State Fullerton. Yep. And he was a finance major on track for the CFP. So we took him on initially part-time, and Kate and I shared him, so he would have an opportunity to get to know her clients as well as ours. He sat for the Series 65 and passed. He also sat for the CFP exam and passed. So by March, we're hoping he'll have enough hours in to use the designations. Is that right?
That's right.
All right. Congratulations, Angel. So I'm going to have Kate come up, and I know she wants to talk to her clients a little bit. And you want to use the microphone?
Okay, I'm going to be very brief because you guys are in for a real treat today with the speakers, so I don't want to take up much time. I just want you all to know that I'm still working through the rest of this year as we transition over. Most of you have been transitioned over to Jim's firm. And the really important question that I've been asked by a lot of people is, who do I call? So for now, continue to call me. My contact information will get updated in the future, but right now everything stays the same. And that's really all I wanted to say. But I'm so glad that you all came, and I'm so excited for all of you. I think you're going to be really, really quite happy working with Jim, and I'm still here. So just remember that. Okay, thank you.
Next, I'm going to welcome Angel to come up, and he's going to brief us on what taxation is going to look like in 2025 and beyond.
Yeah.
Do you want the clicker?
All righty. Well, good afternoon, everyone. Thank you so much for taking the time to join us today. For anyone who's new, my name is Angel Mendez. I'm excited to be briefly discussing everyone's favorite topic, taxes. So specifically, we'll be going over the Tax Cuts and Jobs Act, or TCJA for short, its potential sunset, and how it might affect you going into 2026. So let's start with a quick background on it. It was enacted in December of 2017 and was designed to simplify tax filing and stimulate economic growth through tax reductions for individuals and businesses. Some key changes that it brought along was the lowering of tax rates, increase in the standard deduction, increase in the estate and gift tax exemptions, elimination of personal exemptions, and limitations placed on itemized deductions. So if you look at the chart as well, we can see how drastic of a change it was going from 2017 to 2018, as it essentially doubled the standard deduction and the estate and gift tax exemptions at the time. So fast forward, and here we are in 2025, and without any congressional intervention, it is set to expire at the end of this year, reverting back to 2017 levels with adjustments for inflation. If this were to happen, more than 62% of all taxpayers or tax filers will see an increase in their taxes. But how exactly will this affect tax brackets? Well, in the sunset, as shown in the graph, every single tax rate will be increasing except for the 10% bracket. So we see 12% go to 15, 22 go to 25, and so on. And not only can we see the tax rates increasing, but it clearly shows the income thresholds for each bracket decreasing, meaning you will hit that next bracket sooner, and because of it, pay more taxes that way as well. Another topic to be aware about is the alternative minimum tax, or AMT. Now, AMT is a parallel tax calculation system that applies only if it exceeds your regular tax liability. TCJA significantly reduced its reach, but if reinstated, it could come back and affect many different individuals for the very first time. Stay vigilant about the AMT preference and add back items, such as the state and local tax deductions, personal exemptions, and private activity municipal bond interest. And this graph is just estimating the number of taxpayers who will be affected by AMT. And as we see in 2026 is a huge spike, and onwards is just increasing from there. How exactly do we plan for a potential sunset? Well, planning requires a tailored approach as every situation is unique. However, some general strategies include accelerating income in 2025 to benefit from the historically low marginal tax rates. This can be done many different ways, such as Roth conversions, so analyzing the potential benefits of converting your traditional retirement accounts into Roth accounts. Another way is harvesting some gains, so selling appreciated assets in 2025 to lock in those lower capital gain thresholds. Now, of course, if you are affected by the estate and gift exemptions decreasing, please consult an estate attorney. They will go into more information about exploring strategies such as gifting or trust creation. And we do have a list of estate attorneys in the area that we work with. We'll be happy to provide. All right. I know I went through that pretty quickly, but in conclusion, with discussions still ongoing about the sunset, our focus is only to provide clarity and stress the importance of planning based on current laws and facts. Proactive preparation is always more reliable than depending on uncertain future outcomes. We're here to help you navigate any uncertainties you may face. And if you have any questions at all, please reach out to any one of us on the team. We would love to help. And as a final reminder, you each got this key financial data sheet in your folder in front of you. This is an excellent reference point for tax schedules for this year, credits information, and of course, the Medicare premiums, which is a huge thing for IRMA. So please reference that. It's a great tool. And with that, thank you so much.
Okay, one of my primary responsibilities at the shop, if you will, is to oversee all of the investment strategies, and right down to the selection of the types of investments we use in our client portfolios. And about 5-6 years ago, I came across this newfangled investment called a buffered ETF. I don't know if you've ever heard of that. It's kind of straight lingo, but ETF just means exchange traded fund. And we're going to explain today what buffering is all about using options. I've been implementing the buffered ETFs in our portfolios, like I say, about 5 years now, and it has really done a phenomenal job mitigating downside risk. And we have a guest speaker here today, that Andrew Torak. We've got to make some quick computer changeover for his presentation. But to give you an idea, a lot of your portfolios have First Trust ETFs. And if you look at on your statement, it'll say FT Vest buffered. And that's what we're talking about. And I've used the buffered ETFs in almost all the portfolios now, and it has been getting phenomenal results. So.
All right, well, what a beautiful day, and what a beautiful venue. Jim, thanks for hosting this event. And, I was telling Jim before I came up here, I got a call from a client yesterday evening saying, hey, Andrew, he knows I'm a pickleball player. He said, hey, do you want to play pickleball tomorrow morning? And I'm like, I can't. I have this presentation that I'm going to. I want to make sure I'm there for it. And to which he said, Andrew, it's with Nick Foles. And I said, the Nick Foles? Super Bowl 52 MVP Nick Foles? And he said, yes. And I said, I'm there. So that's what I was doing this morning, making the most of the beautiful weather. But it's a pleasure to come off the court and be here with all of you. We split evenly. He's a very good pickleball player. We matched levels. We had a blast. It was amazing. But as Jim said, my name is Andrew Torok. I'm the vice president at Vest, the options manager, the sub-advisor for these buffer strategies that are in a lot of your portfolios. So we'll be talking about that today. But what was interesting about Nick Foles that really kind of stood out to me is he's very financially savvy. Yes, he made a lot of money in his career in the NFL, but when he found out that I was in the investments world, he said, "Well, Andrew, what do you think about AI and Nvidia? You know, I saw the stock was down hard yesterday. Is it a buy?" To which I told him, "I don't have a crystal ball." And he was he kind of pressed, and I said, "Well, you know, there's two types of people that are in the industry. There's these economists that are tasked with making projections and saying, is the market going up? Is it going down over the next year? And that's a very difficult job to have. You know, in fact, I was an econ major in college, and one of the tough things, and the reason why I don't like, crystal balls is even if you had a crystal ball, think about January 2020. And let's say that crystal ball told you that the COVID pandemic was coming that was going to shut down the global economy. It was going to furlough workers, force them inside, and the world as we know it would shut down. No travel, no eating in restaurants. What would you do with your money? What would you invest in? Well, I'm willing to guess most of you would not invest in stocks because stocks can go down and are risky, and if the market, the economy is shutting down, you want to protect yourself. And yet 2020 was a double-digit year for the markets. Double digits you would have missed out on. In fact, let's say that you knew that the world in business as we know it was going to transition online, and so you had the foresight in January 2020 to invest in Zoom stock, thinking, hey, all meetings are going to go virtual. Well, you'd have less money today than you had in January pre-COVID. So my point is, it's very difficult to predict where the markets are going. Here at Vest, we have the privilege of offering what we call target outcome strategies. We don't have to guess about where the market is going. We just build portfolios that are going to protect you on the way down, participate on the way up, and give you kind of a responsible investment in the equity market. So that's what we're talking about today. But before we get into all of that, let me see if my clicker's working. It's not. That's all right. We were founded in 2013 with a patent. We partnered with First Trust, which you'll see on your statement, in 2019. And from 2019, where we had zero in assets, till today, we've grown from zero to over $35 billion in assets under management. We are the largest provider of buffered ETFs in the industry. And if you think about, why the last 5 years were such a tailwind for buffer protection strategies, which we'll get into what those are and how they work in a second, I really want to focus on what's a little bit of a painful year for everybody, 2022. In 2022, the classic risk management playbook, which is some form of stock bond asset allocation, really broke down. Most investors, when they think about protection, when they think about ballast to equity risk, when they think about diversification, they think about adding some bonds, which tend to not move around a lot, to buffer against equity movements. But the problem is that worked great, but in 2022, both stocks and bonds fell pretty dramatically. It didn't matter if you were 100% equities, if you were 100% bonds, or some other combination in between, you were down double digits. And anyone that went full risk off after a year like 2022 and went to cash, in 2023, what did the markets do? They went back to all-time highs all over again. Let me just see here. And one of the things that's interesting too from practitioners, right, from financial advisors, from folks like myself that work with clients, we've noticed that not only when you go through a year like 2022, not only do we feel losses twice as much as we feel gains, right? Think about who gave Jim a call in 2022. Anybody? So we feel these losses twice as much as we feel gains. In fact, last year was a great year for the equity markets, up double digits again. But what's interesting is not only do we feel losses twice as much as we feel gains, behaviorally, emotionally, your money actually has to work twice as hard. And I'll show you what I mean by that. This is the closest drawdown that we have to 2022. Now, if you'll see here on the screen, this is showing you what your money needs to return just to break even after a 20% loss. It's a little bit small on my screen, but it looks like you need a 25% return just to get back to even after a 20% loss. If you add in some protection and you buffer against some losses, you need a lower rate of return just to get back to even. Now, I think some of you who are not CFAs, who are not CFPs, who are not nerds like myself, it's hard to conceptualize. So think about this for a second. Let's say you have $100 and you lose 50%. So now you're down to 50. What rate of return do you need to get back to $100? Well, your $50 has to double to get back to 100. That is a 100% return. We saw this back after the great financial crisis in 2008. The S&P 500 lost 50% of its value and needed a 100% return just to break even. Does anyone know how many years it took to have a 100% return after 2008? 4 years. That's not even the most extreme example. Let's think about the NASDAQ 100, the Qs, QQQ, the index that holds things like NVIDIA, like Tesla, these high-flying names. 2001, the NASDAQ lost 80% of its value. What kind of return do you need to break just to get back to even after an 80% drawdown? A 400% rate of return. It took 14 years for the NASDAQ just to get back to even and generate that 400% return. So risk management is paramount. I think client expectations, economist expectations are all at all-time highs, but we forget sometimes, we get comfortable, we get used to markets going up, and we forget that markets can actually go the other way and it's hard to recover. So I took a look before this presentation and looked at what typically happens after 2 bull market years, 2023, 2024, both up double digits. Here we are starting the year 2025. Well, what's interesting is if you look back at bull markets, the third year of a bull market tends to have more muted returns. So you can see year 3, we're looking at 2.5% on average if you look at multiple 3-year bull markets. And so, again, risk management in year 3 of a bull market is really paramount. And so we're going to talk about maybe some strategies that are in all of your portfolios or in a handful of your portfolios of what we're thinking for 2025. But before we get to that, I do want to talk a little bit about Travis Hunter. For those of you that follow college football, he was the Heisman Trophy winner last year, greatest football player in college football for the last season. But what's interesting is Travis Hunter, very impressive player, very impressive athlete. I mean, he had 92 receptions, 1,100 yards, 15 touchdowns. But what's impressive about him is the people that he beat out for that trophy. Anyone familiar with Ashton Jeanty? Ashton Jeanty had 2,600 rushing yards and 30 touchdowns. He had more offensive production last year than 120 college football teams, one player. Travis Hunter beat him out for the Heisman. What is it about Travis Hunter that is so special? How did he stand out above the rest of the committee? Boom. He plays defense. Offense and defense, he was a star. First player in history to be the wide receiver of the year and the defensive player of the year in the same season. And so when we think about our portfolios, I was kind of hinting at this earlier, isn't that exactly what we want? Don't we want to participate when markets go up? Don't we want to protect when markets go down? Don't we want to play offense and defense in our portfolios at the same time? And so for those of you that might not be familiar with what's under the hood in these buffer products, I want to make it very simple. So we design our buffers to participate 1-to-1 on the way up. So if the S&P goes up $1, you're up $1 to some predetermined cap. And the reason why you have a capped upside is we're selling away that upside to pay for downside protection. And so this blue box, the buffer zone, is predetermined protection if equity markets fall. So if you're thinking about this, right, think about who here owns insurance, whether it's on your car, your home, your life. Well, why do you buy insurance against those things? There's a less than 3% chance that in any year there's a fire that you're, I guess that's a very recent tangible example, not a great one. Sorry for bringing that up. There's a less than 3% chance that something happens, to your life. There's a less than 3% chance that a neighbor rear ends you in the middle of the night, and yet we all buy insurance against those things. There's a 30% chance that in any year that the equity markets go down. And yet most people, most investors, most advisors that are out there don't buy protection. And so you can think of a buffer strategy almost like you would about an insurance policy against your equity position. Right? It gives you that peace of mind knowing that if the market falls 10% or 15% or whatever level of protection you have, you are not participating in any of that. But beyond that buffer zone, then is when you would start to take on, some losses. But the reason I bring this up is, unlike insurance where there's an out-of-pocket premium paid for that protection, you're paying for your protection in your equity portfolio by selling off excess gains above the cap, right? That gray bar on your screen. So I'll show you a couple of hypotheticals here. S&P, we'll just use that. We have a 20% performance cap with a 10% buffer. Market goes down 20%. You're protected on the first 10, but beyond that, you take on the next 10. So you could have 10% losses. If the market is down anywhere within that buffer zone, you're fully protected, right? That buffer's kicking in, no losses if it's within 0 to minus 10. If the markets are up, you are a dollar for dollar participant, all the way up to that cap of 20%. So if the market's up 25, you're capped out at 20. Now, I want to be very clear because some of you might have questions. If you're in these buffers and you call Jim, say, hey, market's up, 20%. Why am I only up 10? I have a 20% cap. Well, what's interesting is that these results, these levels that you see, these are our targets that we aim to hit at the end of a 12-month period. And because they're ETFs and they can be traded, in and out of a portfolio, you can sell them for full liquidity, unlike an annuity, unlike other, protection type instruments that are out there. You'll see the markets go up. You'll see these products go up. You see the markets go down. You see these products go down. At the end of the outcome period is when we hit our targets, up the same amount to the cap with the same level of protection, right? And so I'll give you a couple of hypotheticals. Let's say 1 month into a 12-month outcome period, markets gap up 13%. You might only experience half of that right away. The reason is there's still 11 months to go in that target outcome period. Think of it this way. If Travis Hunter scores a touchdown in the first quarter of the game, have the Buffaloes won the game yet? No, there's still 3 more quarters to go. And that's the way we want to think about these portfolios. In fact, the market could plateau, have no gains for those 11 months, but you'll see the buffered ETF slowly have gains every single month as it approaches that target at the end of the 12-month period. Same story to the downside. Market gaps down 10%. You have 10% level of protection. You might get some of that buffer, but not all of it yet. Why? 11 months remaining. So these are very, that's one thing that I want to kind of set expectations on. Hey, if you buy into this month 1, there's losses in the portfolio. You're like, hey, I've got 10% protection. Why am I seeing, 4%, 5% loss? There's 11 months remaining to go. What's interesting is the market could plateau and stay down 10% for the whole year. You will finish the year flat at the end of the year. So there's a couple of different ways to implement buffer ETFs. I'll focus on the primary way here in a second, but what I just described is our point-to-point products, right? You have one investment over 12 months, you know exactly what your cap level is, you know exactly how much protection you have, and you can stay invested with that confidence, with that clearly defined terms of your trade. However, most folks, they're not investing on one day of the year. They have monthly reoccurring investments, and so there's a little bit of a timing element there. You want to get invested and not try to time the market. We'll talk about that here in a second. But when we talk about what's available, I want to highlight a couple of numbers if you'll just bear with me. So you'll see on your screen, for a 10% level of protection, this is a product that we just launched 2 weeks ago, January 21st, 1 week ago. And it came out with a 10% level a buffer with a 14% cap. That means you're a 1-to-1 participant over the next year, up to 14, net of fees, you're looking at 13.31% of upside. And you don't take a single dollar of losses until that 10% buffer is fully used up over the next 12 months. Now, the reason I want you to remember that number of 13.31% is to ask the question, what happens on an average 12-month period? Well, if we look, here we are at all-time highs, right? AI, NVIDIA, these tech stocks have really been leading the market higher. S&P 500 crossed 6,000 for the first time late last year, and it's kind of hovered around that level the last few weeks. So what happens after we've hit an all-time high over the next 12 months? Well, on average, you'll see the market is up about 7.38%. If you only look at positive periods, we see an average return of 13.31%. And if we see the next 12 months down, the average down market, just looking at down markets, the average is about minus, call it 8%. Some of you might see where I'm going here, a buffered ETF that gives you 10% level protection. You're fully protected on the average down market. And with a cap north of 13, you're participating in the average up market, right? You're kind of playing offense and defense at the same time. Now, why is this relevant? Well, I mentioned expectations are all-time highs, and you can see that if you look at strategist forecasts for 2025. I wish I had the slide for what they were forecasting last year. Trust me, it was very bearish. The average was about 1% returns for last year, and as we know, markets were up double digits. But this year, the prognosticators, these people on Wall Street, these folks, Wells Fargo, Oppenheimer, BMO, they're all sort of very optimistic. And I like to say, hey, if everyone's thinking the same thing, somebody's not thinking. There's obviously risks in the market. We know that equity markets don't always go down. We know that the third year of a bull market tends to be a little bit more muted. The beautiful thing about a buffered ETF is if Oppenheimer's right and the market goes gangbusters, well, you get 13% of the upside. The average across all of these market projections is only about 11%. If you look at First Trust on the far right, if you read Brian Westbury's commentary, if you look at the risks that are out there with concentration of these names, things like DeepSeek coming from China that are sort of reinventing and getting more efficient the way we use AI in our lives, there's some risks that are out there. And so if First Trust is right and the market's down, call it 11%, well, now you have some protection built into your portfolio. So we like at First Trust Invest, we like to look at data versus narrative. We don't buy into what everybody else is thinking. We think that protection, when do you want to buy protection and insurance? Before a flood or after a flood? Before the flood. It's cheaper. You can get better terms. It just makes a lot of sense. And so with that, how much time do I have, Jim? I can go a little bit longer. Wrap it up. Okay, I'll just highlight one interesting thing. BUFR is our most popular strategy. It's holding all 12 of these 10% buffers under the hood. And what's interesting about BUFR, you don't have to be a CFA, but beta and standard deviation are risk metrics that we look at in portfolios. And what's interesting is BUFR has a much lower risk profile than the S&P, than these low volatility indexes that a lot of investors will use for protection. It has a much better risk profile, lower beta, lower standard deviation. And what's interesting is if we look at all 5 of the major stress tests since BUFR launched, it's done a very, very good job protecting against the downside. In fact, that's what a buffered ETF is supposed to do. It's supposed to protect you on the downside. In fact, the question that I always get is, what do I have to give up on the upside? How much upside am I giving up for that protection? Well, 2022, 2023 gave us a really nice case study. 2022, market's down about 20%. BUFR was down about 7.5%. Great, it did its job. 2023, the market whips back up. Bull market year, market's up over 25%. BUFR is up about 20%. So you're getting offense and defense at the same time, a more defensive, responsible exposure to these equity indexes. And what's interesting is over that time frame, 2022, 2023, you actually outperformed with lower risk. So great addition for folks that are in retirement, approaching retirement, folks that want equity market-like returns that you're not getting from maybe the fixed income part of your portfolio. But understand that over a 10, 15, 20 plus year retirement, you need some equities in your portfolio to pay for your lifestyle over the long run, right? And so we have this really, really great paper. It's only a page or 2 long that can talk about why buffer ETFs make a lot of sense, especially at those early years of your long retirement glide path. So with that, I'll wrap it up, and happy to answer any questions, Jim, or turn the mic over to you.
Can you talk about the tax efficiency if you're using these in a taxable account?
Yes. So Angel touched on some of the tax changes that are going on. The great thing about something like a buffer strategy is that every single year when we reset our portfolio for that new upside, that new protection level, there's no taxes at all. In fact, the great thing about something like an ETF and BUFR in particular is you don't pay taxes until you decide to sell, or you decide that, hey, it's the time to, use that money for living, right? And oftentimes, if you're holding it for more than 12 months, which is exactly the outcome period that we target for these types of products, it's long-term capital gains, which is a more favorable rate than short-term or ordinary income. So, for us that live in California, we want to pay no taxes if we can. And if we decide, hey, we want to sell and take that money and spend it, we'd rather pay that lower, more favorable rate. So, great question.
So in your packets, you'll find an extensive resume of our speaker today. For those of you who have not been here before, you're in for a real treat. I was introduced to Mira by Teresa Harvey, where she was, right there, back in 2008. And you remember what was going on then. We were desperate to find someone who could explain it to us so we could explain it to our clients. So that was the very first year we actually did this event. And Mira was very kind and offered to speak at that event. And she's been doing it ever since. So that's the greatest thing, is to really appreciate her taking the time. I know my clients love your presentations. So without any further ado, Dr. Mira Farka.
Thank you. Thank you, Jim. You guys can hear me all okay? Yeah, I'm loud usually, so it's never a problem. Thanks, Jim, so much for the wonderful introduction also to the danger of dating me, going back to 2008, but hey, who's counting, right? The years are going by. Look, it's always my pleasure to be here at this event. We usually kind of kickstart the year. This is the first presentation I do for the year, and it's usually going very well, so fingers crossed this will be the case this time around as well. So what do we think about the economy? So as I was thinking about the economy today, so how strong it has been, kind of how resilient it has been, even after the Fed has raised interest rates for a couple of years in a row and so on, I was reminded of something that actually Jimmy Carter said once. And it's very apropos because he just left us. But this was what he said. He said something, and this was after he left office. He was no longer a president. But he said something like, my esteem in the country has gone up substantially. It's very nice now that when people see me, they use all their fingers. So, poor Jimmy Carter, right? I'm going to miss him. But yes, my esteem of the economy has gone up substantially. This is probably the most optimistic I felt in about probably 2.5 years or so, maybe 3 years or so. And that's what I'm going to lay out in front of you today. And in fact, look, the economy has been doing quite well. If you think about it, when the Fed started raising interest rates, this was back in March of 2022, almost 3 years ago, right? Everybody thought it was going to be a recession, but the economy has done very well. Real GDP up almost 7%. Employment almost up to 8 million. I mean, consumption has held up great. Stock market has been fantastic, pretty well. We had a dip in 22, but it's picked up quite substantially since then. And in fact, inflation has come down. The reason why interest rate went up is because the Fed was trying to fight inflation. It's come down from 9.1% to like 2.9% currently. This is still outside the Fed target, which is 2%, but quite a bit of progress, right? So in the words of Pink Floyd, there is no pain, you are receding, right? The economy has felt no pain, but inflation has been receding. So certainly these are all good news. And in a way, the Fed must be feeling pretty good about itself. Remember what I said, when they start raising interest rates, everybody thought we're going to have a recession, including ourselves. We were wrong, and I'm glad we were wrong about it. But every thought is going to be, we're going to hit a recession. And the Fed must be feeling like it pulled that sort of 1 in a million miracle, sort of like lowering inflation without shoving us into a recession. And in fact, I don't know if you're kind of familiar with this movie. So you're telling me there's a chance. They probably think this is the Dumb and Dumber movie. That's the movie for today. Somebody asked me. Last year it was Big Lebowski. Today is Dumb and Dumber. You'll see a little bit of this. I know I have a penchant for dumb movies. I know. But So you're telling me there's a chance? They must be feeling like they delivered in a 1 in a million chance of lowering inflation without pushing up into a recession. In fact, they must be feeling like they landed on the moon. So they kind of soft landed the economy. That's another term that you'll see me use today. Soft landing means, inflation comes down, but again, we don't see a recession, which has been the case here. So the question is, are we out of the woods? Is this the case now? Are we out of the woods? Is everything okay? Well, there has been some kind of concerning signs popping up lately. One of the things have been that the rate cut expectation, remember we expected a lot of rate cuts, started last year. Those have been scaled back dramatically. So if you look at it, the Fed actually told us last year, in September of last year, they started cutting rate. They told us they're going to cut 100 basis points last year and another 100 basis points this year, another 4 rate cut for this year. Now, they delivered on last year's promise. Question is, what's happening this year? Well, in September, they told us we got 4 rate cuts. In December, when they met, there was a Fed meeting in December. They said, not so fast, maybe only 2 rate cuts. The market is anywhere between 2 or even 1 rate cuts that they're expecting. So certainly this is a little bit of problematic, a little bit of problem. Expectations have been slashed, and in fact, the market kind of reflects this. This is the S&P 500 performance going back from January 2024 till today. And notice that, the market went up 23% from January of last year till election. And then after the election day, there was another 5%. There was a post-election bump a little bit, a 5% increase from November 5th to December 17. What happened in December 17? We had the Fed meetings, which turned out to be a bit more hawkish. When they told us, not so fast with the rate cuts. Since then, though, the market has kind of treaded water. It's been very range-bound. And of course, yesterday we had a huge freak out about the DeepSeek, the Chinese firm that was mentioned a bit earlier, which basically showed that DeepSeek was able to deliver a very sophisticated model when it comes to AI, but at a lower cost. So much lower cost than US companies, which put into question these big, huge investments that the big tech firms have been putting in AI over the last few years. I'll talk a little bit more about it, but certainly this is a concern. NVIDIA lost $600 billion, the biggest loss ever in one day, right, just yesterday. So this is a little bit of concern. The second thing for concern is perhaps that, one thing that have happened since the Fed started cutting interest rate is that, yes, short-term rates have come down, but if you look, for example, at long-term notes, so this is a 10-year note, right? This is, if you see there, you see the Fed cut happened in September. It's gone up by more than 90 basis points since then. In fact, we've had the Fed funds rate, the short-term end of the curve, has come down by 100 basis points. But if you look at the longer-term rates, the 10-year and the 30-year mortgage, that has actually gone up. This is unusual. When short-term rates come down, long-term rates also usually come down. Not as much, but they do. This hasn't happened here. And part of this has to do with a number of concerns. The bond market seems to be concerned about, number one, finally, the fiscal sustainability of U.S. debt. So if you look at it here, you see that net interest on the debt, we're going to probably pay around $1 trillion this year. This is projections for the coming year. This is more than the defense spending. This is the first time in history that we're going to spend that much money. So that's some concern about the debt and the fiscal sustainability of the debt. The other concern is, of course, there's some uncertainties about the policies of the current administration when it comes to trade, when it comes to tariffs, taxes, immigration, and so on, because they can be inflationary on the margins. And I'll talk a little bit more about this as well. So certainly the bond market is picking on this. Now, another reason for concern is that maybe, perhaps, consumer balance sheets are not as strong as we thought. So if you look at some of the numbers I'm going to show here we have credit card debt. It's up $1 trillion now. Consumers are relying more and more on credit card debt. Of course, interest on the debt is also through the roof. It's the highest it's ever been if you go back historically, the highest we've ever seen. Come down a little bit because interest rates have come down just a little bit, but still very high, right? And on the other hand, another concern is that delinquencies have been going up. This is credit card delinquencies. This is auto delinquencies. They're moved up dramatically. This is the highest delinquency rate we've seen. Compared, if just going back to the Great Recession, which was bigger, but certainly you see that concern. So this gives us a bit of pause as to how strong really are the U.S. consumers. And finally, another concern is that maybe the labor market is not as strong as initially thought. The labor market has certainly cooled off, right? So if you look at here, this is year-over-year employment rate growth. It's come out down from 5% in 2022 to about 1.5% now. Now, of course, 5% growth was untenable. It wasn't going to continue. We're not going to grow at 5%. This was reflecting the fact that we just left the pandemic back then. This was the reopening after the pandemic. But what's concerning here is that we're growing, but we're growing at below trend, below historical trend. So maybe it's come down a little bit more than we would hope. And in fact, another concerning sign is that the Bureau of Labor Statistics actually did some benchmark revisions, and this was back in August. And they revised the numbers from March 23 to March 24. Usually revisions are with lags, right? But they revised them down by 818,000 jobs. Now, this is the largest revision since 2009, since the Great Recession. And the problem is that that number, that downward revision, we haven't seen it yet. It's coming. It's coming in February, because that's when the data actually gets formally revised. So perhaps, the labor market may not be as strong as we think, right? So there are all these worries. So again, there are all this kind of negative news out there that you may think, and it reminds me of the quote from the movie, we got no job, we got no food, our pets' heads are falling off. So there's some concerns over there in the market about how strong and how resilient is this economy. So then the question is, what's the outlook? What do we think is going to happen with all of this going on, right? And we have the usual scenarios. So is the economy going to soft land? Again, just to kind of define the soft landing, this is where inflation comes back to 2%, which is the Fed target, and we avoid a recession. Or is the economy eventually going to fall into a recession? And to these two scenarios, we have a third scenario that has popped up more recently, and that's a possibility of stagflation. This is when growth kind of slows down, but inflation picks up. And part of this has to do with the tariffs and trade sort of policies of that have been kind of bandied around by the new administration. What do we think? What do we think is the outlook? Well, we think probably none of these scenarios are possible. I have to say, we actually think that the economy, the growth is pretty strong, economy will hold pretty well. So in a sense, we see kind of a no landing scenario when we have solid growth, but inflation will remain quite stubborn. So that's kind of the outlook that I have today. As I said, I'm optimistic when it comes to growth. I'm more pessimistic when it comes to inflation. Having said that, of course, there's a bunch of risks, which I will discuss today. Of course, some of it has to, again, number one risk is inflation, a little bit of bifurcated economy, and there's some policy concerns that I'll discuss today. So this is kind of, in a nutshell, the overall outlook. Now, the main reason why, there are kind of four main reasons why we think the economy will continue to grow and will not fall into a recession, at least over the next couple of years, which is our forecast horizon, right? So, and history kind of has a couple of useful lessons for us here. So if you look back historically, it's very rare to avoid a recession when the Fed hikes interest rates, like it did in 2022, right? But there have been three cases historically, in 66, in 84, and in 94. And all of these have different reasons why this happened. In 66 and 84, that's because we had huge government spending. Back then, again, Vietnam War and then the fiscal spending on defense in the mid-'80s. 94 is because we had a high-tech boom. Elements of these are present here today, so I'll talk about them. So take first the government spending, right? So if you look at government spending, so this is real government spending year over year. Notice that is growing as high. I mean, the rate of growth recently has been almost as high as back in the 80s and the 60s. So again, and some of these, we're not done with spending, it seems. There's a little bit more government spending in the pipeline. The infrastructure bill was approved about 2.5 years ago. There's still more money in the pipeline, probably another $800 billion. The CHIPS Act has another $80 billion left. The Inflation Reduction Act, this is the act that was passed under Joe Biden. This was in August of 23. That one is a bit harder to score because a lot of the spending there is coming through tax credits for the green energy. We think the new administration will rescind a lot of those, but perhaps not everything. So maybe there's still a few more sort of spending in the pipeline here, between $200 billion to $800 billion left. So in the words of the great Dolly Parton, thanks to all the Botox and fillers and the work I've already had, my face pretty much maintains itself. So we think, thanks to all the government spending, the economy will hold. So this is the first reason why we think we'll see some more growth, right? Great Dolly Parton, love her. Now, the second reason why we think the economy is going to do okay and sort of not fall into recession but continue to grow has to do with AI, the AI revolution. Now, of course, big tech firms have spent a lot of money into this, already spent a lot of money on investment. And in fact, you can see this in some of the graphs I'll show. Here, we have real investment. So this is investment by firms in general on three main categories. One is equipment. This is compared to 2019. So equipment has kind of grown 5%, nothing big, right? But then we have structures, not really, in fact, it's actually negative. What has taken off dramatically is investment in intellectual property. A lot of that is AI spending. A lot of that is basically these big tech firms pumping money into semiconductor sort of data centers, you name it, chips, you name it, right? Now, if you look at this, the AI revolution has already boosted growth. So if you look at this is the contribution of that spending on AI on real GDP. And it contributed quite a bit. It's the biggest contribution to growth we've seen historically, much higher than the 90s. Remember, the 90s is when we had that soft landing scenario. Again, we avoided recession, inflation came down. But it's actually not just much higher than the 90s, but it's also much higher going back, historically for 60 years. Now, before Monday's bloodbath, a lot of these big tech firms were actually, they're set to spend about $1.4 trillion more dollars in basically AI spending, in investment in these, in AI. We think that number may be a bit exaggerated right now. We think this is a little bit too high, given the fact that perhaps what the Chinese company showed, maybe things can be done a little cheaper. So perhaps that's not going to be a lot. We're not going to see as much investment as was planned or penciled in originally. But I actually don't think this bad. I know everybody's freaking out, but I don't think this is a bad thing. And I think this is actually long term is going to be a huge positive, especially for productivity growth. I mean, these are productivity numbers, right? So we had a slump in 2022, and then it's picked up dramatically since then. And again, cheaper, more efficient AI models, it's going to boost productivity growth, which is great news for growth in the long term. So I see this more as a positive. In the long term, short term is going to create a lot of dislocation, but long term I see it quite positive. Now, the third reason why we think the economy will continue to do well is that, the economy has kind of been comfortably numb. It's a lot of Pink Floyd today, but comfortably numb to high interest rates, right? So if you look at it, and that's because, consumers were insulated by this higher rate because a lot of them locked in low rates during the pandemic. So for example, this graph kind of makes this point. So if you look at 30-year mortgage rates, they're about 7% right now, so give and take, right? This was a couple of days ago that I updated this. But if you look at the effective rate on mortgages, it's much lower. It's 3.9%. I mean, in fact, 60% of mortgages have a rate less than 4%. 80% of mortgages have a rate less than 5%. So that's the reason why we haven't seen a huge decline in consumption, given that a lot of people were locked in low rates from before. And the same goes for corporations. They also locked in very low rates during the pandemic. So that's the reason why, if you look at it, and this seems like an anomaly, but historically, when interest rates go up, corporate interest payments go up as well. Well, here is the Fed hike right here. It's gone down dramatically since then. Part of the reason is precisely this, is that while interest rates have gone up, companies are earning higher interest in their assets, but their debt is denominated at very low rates during the pandemic. So you see this huge decline in corporate interest. So this is actually good news, means positive for growth. And the words of Dumb and Dumber, I expected the Rocky Mountains to be rockier than this. Yes, we expected the economy to be rocked more by interest rates, but it hasn't. And this is actually good news. This is decent news, right? Now, the fourth reason why we think, again, conditions are pretty good for continued growth is that financial conditions are actually quite loose. They're very easy. It's easier to get credit. And you can look at this from a variety of indicators. There are many indicators out there. I chose a couple to show here. But if you look, for example, so I'll show a couple of graphs in this, a couple of lines in this graph here. But easier condition is down here. Tighter condition is up there. If you look, for example, at credit spreads, this is, here's the Fed hike in March of 2022. Here is the high yield credit spreads, right? So again, this shows how the high yields are basically more distressed bonds versus treasury yields. They've come down, they're tighter now. They're even lower now than they were compared to March 2022, before the Fed raised interest rates, even though interest rates now are 450 basis points higher than back then. So again, there are looser conditions here. If you look at another indicator, which is the Chicago Fed Financial Index that's put together by the Chicago Fed, again, easier in the bottom, easier financial conditions now than back then. And the news is that, the good news in a way is that the easier financial conditions didn't just happen when the Fed actually started lowering interest rates, which was last September. It started before that. It went back to December of 2023 when they first signaled that they were pivoting to rate cuts. Remember, there was a meeting in December of 23, about a year ago, when they told us they're going to pivot to rate cuts. And if you look at, and again, many indicators will show this, but I focus on one of them, which is high yield bond issuance. So this is the number, this is in billions of dollars. This is all the way to the fourth quarter of 23. It was very depressed levels. The firms were not issuing a lot of bonds because, again, they were very worried about the high interest rates. But then there was a pivot to rate cuts, and then you see huge increase in activity right after. So again, financial conditions seem a little better. So that's good news. That's the fourth reason why we think we will see continued growth. But besides these reasons, I mean, if you look down deep, I mean, the fundamentals of sort of the economy still seem to be strong. We still have a pretty strong consumer. If you look at consumer balance sheets, and here, for example, we see another data. We see household debt as percent of disposable income. This is still below the historical average. Now, of course, credit card debt, which I mentioned earlier, has gone up, right? We saw that graph earlier, but mortgage debt has stayed quite low, actually. And mortgage debt makes up 80% of household debt. So again, overall, the balances of consumers look pretty decent. Household balance sheet look pretty decent. Another good development, wages are finally growing at above inflation rate. So if you look at this number here, this is inflation, and here we have wage growth. So from 22, 23, inflation grew far higher rate than the wage growth. Since then, this has reversed. So over last year and a half or so, we see a reversal of this, which again is good news and should boost spending. Now, and another thing is that, we're splurging on everything. I mean, if you look at, I'll show a couple of indicators here, but you look at retail sales, right? And here is trend. This is in billions of dollars. So retail sales took off since the pandemic. They're running now about 100 billion above historical trends, and there's no sign of slowing down. There's actually an acceleration over the last couple of months. We're actually taking flights. This is the foot traffic through our airports. This is millions of people. In 2024, every single month, when it came to foot traffic, was higher than in 2019. So people are traveling, people are going to concerts. So here is, and by the way, talking about travel, January this year also, we only have January numbers so far. It still looks good. 2.2 million travelers through our airports, higher than last year and higher than in 2019. So people are traveling, people are going to concerts. If you look at the Live Nation entertainment revenues, this is the biggest venue that sells tickets. It's an online platform that sells tickets. They have the highest revenues ever recorded, right? Last 3 years have been great. I begrudgingly say we should thank Swifties for this. But I say begrudgingly, I'm not a huge Swiftie fan, but we gotta give dues where they belong. As the Wall Street Journal says, this is Taylor Swift's economy and we're all living in it. But certainly people are splurging. They continue to splurge, right? Now, another thing is that the labor market is actually doing fine. Yes, it has slowed down quite a bit, but if you look at this number, all it means it's normalizing. So here, for example, we have labor supply, right? So millions of people. And here's labor demand. So this huge gap here was right after the pandemic. Remember all those labor shortages that were going on everywhere? You couldn't find a dining place to eat because there were shortages everywhere and you had to wait hours and hours. Well, that number has kind of come down a little bit and sort of normalizing. And the other good news that I think is that, we haven't seen any massive job losses, right? So if you look, for example, at jobless claims, this is unemployment claims, right? This is a leading indicator to see where the labor market is headed. Well, it's actually pretty tame. It's actually come down. The claims have come down. The number where we worry about recession is about 260,000 per week. We're far away from that number, right? So I'm not really that concerned. So labor market has slowed down, but again, mostly normalizing. In fact, I mean, the only people I know that have been losing jobs is the NFL coaches. No, I mean, it's been a horrible year to be an NFL coach. Horrible year. Horrible year. I've been thinking about dusting off my CV with all these openings. Maybe the Dallas Cowboys will finally get there. They'll come back once I get into there. Yeah, right? So I'll take my chances. I'll take my chances. But certainly the job market seems pretty good. And the other thing is that businesses are doing okay. So in fact, if you look at business optimism, right? So this is at a national level. You see the Small Business Sentiment Index. This is from the National Federation of Independent Businesses. You see that huge bump over here? This was right after the US election. So small business optimism off the chart. We actually do a survey at the Wood Center at Cal State Fullerton for local businesses. We have about 700 local business leaders that participate in our survey. So we ask them the same question. We always ask, we do a quarterly survey, ask their level of optimism, and we find the same thing. So here is our survey for the last quarter. This was done in December for first quarter of 25. Optimism has gone up. So businesses in Orange County are the most optimistic we've seen them since the first quarter of 2022, since right before the Fed started cutting interest rates, right? And then it seems like this is driven by the election, by the goodwill at least so far, towards the new administration, because we did ask them. We said, look, how optimistic are you, or pessimistic compared now that we had an election, post-election? And 73% told us they're more optimistic since the election. So we'll see. But certainly quite a bit of optimism in the business world. And in a sense, the business fundamentals are actually, they look fine, they look okay, right? So if you look, for example, at corporate earnings, we had a mini recession back in 22 when the Fed started raising interest rates. But we've recovered since then, and last 3 quarters, the fourth quarter is also shaping up to be real good. Projections for this year also seem very strong. Again, we'll take them with a grain of salt, we'll see what happens, but certainly projections are good. Another thing is that if you look at speculative grade defaults, so these are the defaults for companies that have weak balance sheets, they've come down a little bit, which is also a little bit of good news as well. So again, we take this as pretty sort of cautiously optimistic, right, going forward. Now, another thing that is actually sort of cause for optimism has to do with the rate cuts I mentioned earlier, right? So remember, the Fed already delivered 100 basis point rate cuts to the economy. The market loved it. So I remember, I don't know from the movie if you remember, so when it says, just when I thought you couldn't get any stupider, you go and do something like this and totally redeem yourself. So back then, last year, the market thought the Fed had redeemed itself in the eyes of the market. They delivered a 100 basis point cut. Great news. The market loved it. It went off. Now, those rate expectations, as I mentioned earlier, have been scaled back dramatically. But even if we don't have any more rate cuts, right? Let's say we see nothing this year, no rate cuts this year, still those 100 basis points are going to percolate through the economy, kind of rejuvenating the economy a bit. In fact, I mean, if you want to see this in a scale of the business cycle, so this is your business cycle. I spent hours doing this, by the way. So that's the right time on. So you got your recession here, where we were in 2020. You got your early cycle recovery. You got where we were in 2024? Somewhere here, somewhere like in late cycle. But we think the recent rate cuts will kind of put this process a bit in reverse, kind of rejuvenate us, kind of bring us back up to kind of mid-cycle. So there is where credit expands, monetary policy is neutral, and corporate earnings pick up. We call it the Benjamin Button economy, kind of like a aging in reverse, a little bit process. So this will help, and this is coming down the pipeline. Now, another reason for optimism, we think, has to do with the new administration. Some of the policies, not all of them, some of the policies of the new administration, we think we kind of supportive of growth. And the most important, one of the most important, which I think has gone kind of underreported, or at least doesn't get as much attention as I would think, are deregulations. This matters. So if you look at it from 1980 till today, the U.S. regulations have cost the U.S. economy, and these are some estimates out there, but on average about $4.8 trillion. Just to put it in perspective how big that number is, right? So we figured, let's look at it this way. So here is your countries ranked by GDP. GDP of U.S. is almost 27 trillion. China is the second biggest with 18 trillion. If they were their own country, the US regulations will be the third biggest in the world, far bigger than Germany, Japan, India, and everybody else, right? So this matters. So they're quite big, they're quite hefty. I mean, the code of federal regulations, it's about 112 million words. It will take you 6,500 hours to read it. That actually is about 3 years, 175,000 pages. If laid sort of like side by side, they will pave the length of a full marathon, 26 miles. So this is quite burdensome, I tell you, it's quite burdensome. I mean, just to put in perspective, again, this is another thing I spent some time. So how long will it take you to read the Game of Thrones? 98 hours, it'll take 60 hours for Harry Potter. The Bible, for God's sake, will take you just a week to read. But this thing takes 3 years, so it is quite burdensome. So regulations, spending quite a bit of time on silly stuff, right? But that's what keeps me kind of entertained as I put this together. But this matters because the first Trump administration had a pretty decent record at deregulating. So here, for example, if we look at the economically significant regulations by administration, so these are regulations that cost the economy $100 million and above, right? So here we have Bush, here we have Obama, here we have Trump, and this is Biden. So certainly Trump had a lighter regulatory touch. If you want to translate this in terms of dollar amounts, the regulatory touch, the average regulatory cost per year was $43 billion under Bush, $110 billion under Obama, and about $10 billion under Trump. So again, lighter touch, right? And I don't know if you remember this, but this picture, this picture from 2017. So when the first Trump administration started rolling back regulations, these were the regulations in 1960, these were the regulations in 2017 when he started rolling them back. And in a kind of rare moment of showmanship, there's President Trump cutting red tape. I don't know what he's going to do this time. So maybe what's he going to do to regulations? Maybe, I don't know, bring back the dump truck or slay them with an inaugural sword. So we'll see. But look, one thing is that everybody's excited about Doge, right? So here's Doge. That's the dog meme. Everybody's kind of excited about Doge, which is the advisory board that is tasked with kind of slashing spending, but also modernizing and increasing the efficiency of the U.S. government. So we actually asked our business leaders about what they thought about Doge and what they thought, how successful they thought they would be. And 16% think is going to be very, very successful with lots of cutting spending, lots of deep structural reform. But the vast majority think is going to be somewhat successful. Some reforms, but less than promised. So overall, a lot of goodwill. 70% of people are thinking this is going to be successful. Only about a quarter, a bit more than a quarter, think that is going to be not very successful, just going for low-hanging fruit. But only 2% think is going to be a total failure. So that's a lot of goodwill out there. Look, Doge has promised about $2 trillion in cuts. Obviously, this is super excessive. We only have, the discretionary budget of the U.S. government is about $1.9 trillion. So it's a bit excessive, but it's true that there is quite a bit of estimated waste, fraud, and abuse in the system. And some of the Inspector General sort of reports have shown this between $200 billion and $500 billion a year. This includes entitlement program. I say if they do anything, halfway through, $250 billion to $300 billion, we call it a day, we call it a big success. This is still quite good, right? So certainly this is what makes us quite sort of a bit optimistic about the future here. And the second reason for optimism when it comes to the new administration has to do with taxes and spending. We already talked a little bit, Angel was talking a little bit about taxes here. And you didn't want to say too much about what will happen. No one knows what will happen, right? This has to go through, the bill has to go through Congress, it has to pass. So no one knows what will happen, but since the economics is like the science of the impossible, I put something together here what we think will likely go through Congress. So we do think that they're going to be able to extend the tax cuts that are expiring this year. That will cost in a 10-year horizon about $4 trillion. And we do think that the administration will keep some campaign promises. No taxes on tip, that's about $200 billion. Again, this is scored on a 10-year horizon. We do think they're actually going to increase the SALT cap deduction, not completely remove it, but probably take it from $10,000 to about $25,000. And that costs, I mean, if you score it dynamically, costs about $300 billion over a 10-year horizon. And a few other tax cuts, lowering the corporate tax rates to 15% for domestic manufacturers, some more additional tax cuts for businesses. Overall, the package will probably cost in a 10-year horizon about $5 trillion. How they're going to raise spending, how they're going to pay for it? Well, some of it is going to come from tariffs, which are coming. Some of the, and I'll talk a little bit more about tariffs towards the end, but probably at $2.7 trillion in a 10-year horizon. Some will come from reverses of the Inflation Reduction Act, and then some from waste and fraud, so $3.6 trillion. So you can see, now you can see the math, right? Obviously, while tax cuts are great for growth, budget deficit, this will add to the budget deficit. But again, by our estimation, by $1.3 trillion over the next 10 years. So overall, a pretty decent outlook, the strong economic outlook, strong consumer finances, sort of strong business outlook. We have rate cuts. Perhaps some of the new policies of the new administration are going to be pro-growth. So what could go wrong? What are the risks, right? Well, the main risk, as I mentioned earlier, is inflation. Fight against inflation is not over. In fact, it's actually kind of picking up again. So if you look at CPI inflation here, it was coming down earlier last year, but it's been going up again. So again, this has been it's going to, and we've warned about this for years and years, that inflation is going to be very hard to bring back to the 2% target. This is a quote by Governor Waller, that's the governor of the Fed. He goes, look, I feel like an MMA fighter who keeps getting inflation a chokehold, waiting for it to tap out, yet it keeps slipping out of my grasp. So the vision of the Fed as an MMA fighter is a bit too much, I think, but I get the disappointment, right? So it's been very hard to actually bring it under control. And of course, some of the high inflation, so inflation is proven to be sticky, it's proven to be quite stubborn. Now, of course, some of this has to do with commodity pricing. Gold is still up $2,700. It's been there for the entire year last year and continues to be so. Coffee is up almost double compared to a year ago. I mean, this coffee story has sent the entire nation of Italy into depression, for God's sake. I sympathize with Italians, but I only panic when the price of scotch gets out of hand. So I think we're okay. I think we're doing okay. But look, I think I found a culprit. I think I know why inflation has been sticky. So I say blame the Swifties again, because Swiftie friendship bracelet, these are the designer kind, are going from $1,200 to $5,000. So you can see why we got sticky inflation there. And of course, there's Tay-Tay, that's Taylor Swift over there. Cat lady extraordinaire, but certainly. So look, all joking aside, the reason why inflation has been sticky and will continue to prove sticky, and again, that's the biggest problem we see on the economy, is the inflation story, is two things. One is housing costs. So if you look at it here, if you look at simply rents, this is from Zillow. This is rents compared to 2021, they're up 32%. But CPI rents are only up 24%. So it means that the CPI measure of rents in the consumer index has actually understated rents for the long time, for at least in 22 and in 23, so it has quite a bit more to catch up, certainly. Now, rents have come down a little bit, but this will take a while. So these dynamics will keep inflation sticky for a while. And the second reason for this are wages. If you look at CPI, service CPI, so if we take away housing from everything and we only look at service inflation, right? So if you look at the numbers here, it's running at 4.5%. That's still about 1.5% the historical average. A lot of this is due to things like higher insurance costs, higher maintenance costs, but a lot of this is pushed by wages. Wages are still running about 1.5 percentage points higher than they should be, with a rate that is consistent with 2% inflation. So again, this inflation story will continue a bit more. Now, the second reason why that kind of makes me a little bit more worried when talking about risks, sort of downside risks, is this idea that we do have a bifurcated economy, kind of like a tale of two Americas. And some of the numbers I'm going to show here bear this out. So if you look, for example, at income, share of income by cohorts. So the top 40% account for 71% of overall income. What's more concerning is that the top 40% also account for 62%, almost 2/3 of spending. So the economy is very highly dependent on how good the top 40% are doing. Well, this is a problem because it makes it more vulnerable. I mean, and the economy is doing well because these people have been doing fine, right? So if you look at it since the Fed's, by the way, the top 40% also pay 92% of all taxes. That's not the point. The point I'm trying to make here is the reliance on this top 40% for the economy to do well. I mean, and as long as they do well, the economy will do well. They've been doing fine since the Fed raised interest rates. Stock market wealth is up $14 trillion. Housing wealth is $4.5 trillion. But they own about this cohort owns 87% of stocks, 74% of the housing market. So those have been doing fine. This share of the population has been doing great. That's why the economy, the aggregate numbers have looked great. The problem is the bottom 60% are not doing so great, and that makes the economy very vulnerable. So if you look at it here, a bunch of statistics, but I look simply at excess savings. This is since before the pandemic. So top 40%, this is adjusted for inflation. This is in real terms. That's up $1.6 trillion. These are the people that are going to the Taylor Swift concerts, taking the transatlantic flights, and doing the theme cruises and all that. The middle income kind of still has some positive saving, not as much, but still does. But the bottom is actually worse off now in real terms than they were prior to the pandemic. So this is a problem. And in fact, these are struggling. You can see the bottom 40% struggling. One way you can see that there's stresses here, of course, those high delinquency rates I showed earlier, mostly because of this cohort. The other thing we look at, if you look at multiple job holders, right, people holding more than one jobs to make ends meet, it's the highest we've ever seen historically. And then again, driven by the bottom 40%. And this makes the economy pretty vulnerable, right? So if you look, for example, at spending by this cohort, this is the bottom 50% of the income distribution. That has actually come down quite a bit. Historical average is around 4%. Last year, they spent about 2%. So again, you see the stresses here as well. And we kind of had some inklings for this because for the first time ever last year, Coachella and Burning Man did not sell out. And last time this happened was 2010. This was during the Great Recession, right? So this is a little bit of worrisome. J-Lo, for God's sake, had to cancel concerts because of poor ticket sales. So again, Taylor Swift is doing all right, but the rest of these, but you can see some strains at other segments of the population. Another thing that concerns me is that evidently one of my students told me that the Eras tour, the Taylor Swift concert is over. This is gonna be another biggie for the economy. Woo, it's terrible, terrible. Now, another thing that kind of concerns me a little bit is that, of course, and you all know this, market is quite frothy. So if you look, for example, at market valuation, this is the Buffett indicator. This is the ratio of Wilshire 5000 to GDP. So it's now 209%. It's far above the 40%, the 100, far above trend, right? So again, lofty valuations are problematic, and as we saw yesterday, because a little bit of shock to the system, you see that the market collapses very, very quickly. I'm not that worried because Jim got all my money, so I'm not worried about it. I got Jim to worry about it, neither should you. But it's a little bit of a concern. But another thing but on the other side of this, I'm thinking there's still quite a bit of risk appetite out there. The market today has recovered, not recovered fully, but is doing better. Trump issued an inaugural, the meme coin, remember? 2 days before inauguration. It's still worth billions of dollars, which gave me an idea. So I did spend some time about how to create a meme coin. So I figured I'll issue my own. Took a while to put this together, but it's great. It's fantastic. It's backed by nothing. So yeah, it's really good. Another concern actually is, and this is probably the bigger one, are possibility of policy mistakes. One is the possibility from Fed mistake, right? So what are the possibility for mistake here? Well, given that they're faced with kind of stubborn, sticky, and maybe increasing inflation, maybe they'll go the other way and raise interest rates, right? So that's the fear that is in people's mind, kind of preying in the market. I think the real fear is that maybe the Fed will go to the URL. Remember this, that Karen Bass, you guys followed this? When Karen Bass gave a press conference and said you have to go to URL, but there was no URL. So the fear is maybe the Fed will go to Karen Bass's URL and find nothing there. But no, look, I actually think this is a bit overblown. I don't think the Fed will actually increase interest rates this year. That's because Jay Powell's Fed is not as hawkish as it sounds. One number that you can look at, if you look at their own projections, right? This is the percent of Fed officials that are more worried about rising unemployment. It's usually the vast majority seems to be more concerned about rising unemployment, and this is over the last couple of years when unemployment rate has been at 6 decades low. Right, so again, it kind of makes me think they're a bit less hawkish than they would try to. They would make you believe. I do think they're probably going to deliver one rate cut this year because, again, inflation is a problem, as I mentioned, but no rate hike. So certainly this is the case. Now, the other concern, of course, are tariffs. What impact will they have on the economy? As President Trump said, tariff is the most beautiful word in the dictionary. He has threatened to give a universal tariff of about 10 to 20%, China 60%, Canada. These are all proposals so far, like Canada, Mexico 25%. Everybody's freaking out. You have these predictions by all the economists, we're falling into a recession, stagflation, high inflation, you know what? So these are the times when I'm actually reminded of something that Warren Buffett actually said once. It is that anyone who hires an economist has one employee too many. I'm a traitor to my own race, I know. But, but look, what are the impacts on the economy? We do think not all of this will become reality. So let's say if you look at the current tariff rate, it's actually only 3%. If a full implementation of what Trump has proposed will take it to 17%. We don't think it's going to go that high. We think some of this is negotiating tactics. It will go high, it will increase, but probably at about 8, maybe 10%. That's what we're thinking overall, right? What is the impact of this on the economy? So we're in a few numbers. Again, these are all very preliminary because I don't know what's going to happen yet. No one does, right? But this is very preliminary. Assuming the overall tariff rate goes to 8 to 10%, we think it's going to be a mild stagflationary shock to the economy. So if you want to look at, say, the real GDP growth, so without tariffs, between now at the end of 2029, so the end of the decade, 10% growth. With tariffs, and it depends whether there's retaliation, whether other countries retaliate or they don't. But again, a little decline here, so growth will kind of be flat next year if they were to be immediately imposed. Obviously, that's not happening, but let's say if that's the case, then at the end of, but the gap kind of narrows towards the end of the decade, right? So we're about 0.4 percentage points below where we could have been with tariffs. If there is retaliation, the hit to growth will be a little bit more. So probably at the end it will be about 1.6 percentage points, but the gap kind of narrows. What about inflation? Same story. So if we go from here to the end of the decade, a 13% increase in inflation, with tariffs, with no retaliation, inflation is going to be 2.1 percentage point higher, cumulative, right? This is all cumulative. But with retaliation, probably about 1.5 percentage higher or so. So mild stagflationary shock, and certainly this is an issue. Now, I'd be remiss if I didn't talk about the fires a little bit. So I kind of did not want to bring it up, but it is, it is sort of, it's going to affect the local economy quite a bit for quite a while. It's going to have long-term effects. Property damage so far has kind of been assessed to be about $55 billion. Perhaps insurance costs are going to be anywhere between $25 billion to $35 billion. And these are very preliminary, right? This will exacerbate the problem with insurance that we have, the insurance crisis we have in the state. The FAIR plan is in trouble. So if you look at their finances, they have cash in the bank, about $300 million. Reinsurance will be, they have reinsurance money that is accessible to them, another $2.5 billion. But overall, their exposure is bigger than what they have access to. It seems to be about $4.5 billion, which is a problem. How big will be the impact in total economic cost? Again, this is harder to score. If you look at natural disasters of the last 50 years in the US, the biggest actually was Katrina. It cost $170 billion in lost output, followed by Harvey and Maria, and then we had Irma and Sandy. Now, some of the estimates I've seen out there are a bit high. They put the LA fires at the total economic loss, right? This is including lost output and wages and everything from the disaster between 250 and 275. We think this is a little bit too high. We think it's going to be a little lower, maybe between 150 and 170, but this is still kind of vying with Katrina for top spot. So certainly a huge thing. Now, of course, growth will take a huge hit in the short term over this probably the next 6 months or so. But the moment we start rebuilding, you're going to see a huge pickup in growth. So again, it's a washout in the long term when it comes to just simple numbers in terms of economic growth. But this is kind of where we see things developing. And again, this is very preliminary. Where does this leave us? I mean, the next question, so we see a pretty okay economy. Rate cuts will help. We've got administration policies that could be conducive to growth. We got maybe perhaps a mild stagflationary shock from tariffs. But overall, the question is, when will be the next recession? And usually, for those of you guys who have been here before, I do get my clues from Hollywood. It's really foolproof. This time we've got, I don't know if you remember Ben Affleck and J-Lo. They got together in 2002. Oh, they broke up in 2004. The economy grew those 2 years. And then we had another 3 good years until we fell into a recession. Same cycle. This is the Bennifer business cycle, if you will. But the same thing is repeating here. They got together in 22. They broke up last year. So I'd say maybe another 3 years till we worry about the next recession, maybe, right? So this is our forecast. We called it the roaring and the roiling 20s. The roaring because of good growth, but the roiling because of the high inflation. Here is decent growth over the stuff that you see a little bit kind of blurred here. This is the forecast, so pretty decent growth. Real GDP growth, very decent. Pretty strong employment growth as well. Unemployment rates to remain low, but CPI inflation, again, kind of sticky, as I mentioned before. So where does this leave us? I usually end on a wish. I started with a 20th century politician. I started with Jimmy Carter. So let me end with another politician. This time by Winston Churchill. There are few virtues Americans do not possess and few errors they ever avoid. So may we avoid all the policy errors, and may your bottom line be better than this forecast. So with that, I thank you, and then I'll take any questions you guys have. Thank you. Thank you. Anything? Yes.
I'm always curious. So you said consumer spending is way up.
Right.
But so is credit card debt into the billions. What happens to all the defaults?
Yeah, good question. So I was trying to draw a fine line between whoever's doing most of the spending are not the same people who are having all the debt, right? So the top 40% is kind of carrying the economy because they're doing fine, they have excess savings. Their debt is not high. The huge increase, and the problem is that the aggregate data is given in aggregate. We don't have disaggregated data by income in terms of debt, but we can take a good guess. We have some sort of back of the envelope data that we can look at, and we see that the high stress, the highly indebted consumers are those that are in the bottom 50% of the income distribution. So they're not the same people. But as I said, this is a vulnerability. If the bottom half of your population is not doing as hot, it's not doing very well, this is a vulnerable recovery. Yeah, sure, the aggregate numbers will look good because the top 40% are doing well, because the stock market has done well, home prices have done well. But that's where you get into trouble. The moment the stock market, you have a huge dip in the stock market, the top 40% will retrench, and then you're looking at a recession. I mean, we're not forecasting this, but these are risks, right? So that's, so how it affects us, I mean, the only good news that I saw more recently is, yes, overall, even delinquency rates, especially auto loans have gone up, credit card loans have gone up. Again, this is still a small portion of the economy, only deals with the bottom 40% of it. And remember, they have less spending anyway, so it doesn't affect directly the aggregate numbers. The other good news I saw is that if you look you have to like squint even in the graph, you see very little, some of that has come down a little bit. Some of the delinquencies are going down. So that gives me a bit more hope that hopefully, even for the lower income of the distribution, things may turn around because of increase in wages, let's say. But it's a little bit more complex. I appreciate the question. Yeah, certainly. Yep. Any more? Yes. Norm.
Yes.
How we doing?
Good.
I talked about the bottom 60% of, you should be very happy.
It seemed like most of your statistics at the beginning of your presentation made the economy look pretty good, which would be under Biden's administration. But now,
Sure, we'll give it to you. Sure,
excuse my bias,
totally, but sure.
but when Trump says the world is a mess, or the United States is a mess, and he begins cutting or firing in retribution or whatever of government employees, or policies are on hold, that means there could be some significant unemployment.
Yeah, I mean, look, again, the whole point, and we can argue about, yes, some people are going to be affected. I think he closed down the DEI offices, right, across the federal government. Some can argue that this may not have been necessary to begin with. I mean, we have to see the efficiency of those people, right? So again, there'll be some unemployment, perhaps some tick in unemployment, but I mean, the federal government itself is like 2.5 million people. If you fired a couple of thousand people, it's going to be a blip in the statistic, right? And again, I'm not trying to dismiss it. I'm saying, if you look at the efficiency of the people, so would you miss these people? That's my question. And we can argue that. We'll see. Maybe we'll miss it. I don't know. We'll see. More questions? Yes. Sorry. Yeah.
So you had an inflation chart
Yeah.
with tariffs, and the projection for inflation, if there's retaliation,
It's actually less, a little
lower.
less.
Is that,
Yeah.
is that exports, not consumption?
Yeah, no, because I mean it's slightly lower. Right? With no retaliation is going to be a little higher. With retaliation is be slightly lower, and the reason being is because it's going to be less trade overall, right? So less overall trade, you import a bit less, so therefore it's a minuscule difference, but that's a good point. Yeah. So if they retaliate, but if they put tariffs on our exports to them, that means that we're going to consume more domestically, so it's going to be less trade overall, so that captured that portion. I mean, again, this is based on like plain vanilla models in international economics. Usually if there is retaliation, this is like common practice to assume that there's going to be less trade, so therefore we export less, we import less, we consume more domestically, so the impact on inflation will be less if there is retaliation, but very slightly less, right? If you see, there's not a huge difference there, so between the two. But yeah, good question, yeah. More, yes?
What kind of tools are you using to come up with these projections?
So yeah, very good question. Yeah, what we did is, I mean, it's not easy, right? Because we don't even know what the tariffs are going to be. So there is some, goes to the heart of the question. There's some sort of plain vanilla macroeconomic open economy models that incorporate tariffs, so we use that. But what I did do a bit more work, and I haven't quite completed it, but because I want to do more. I went back to the tariffs of the first Trump administration. Remember, they put tariffs on, so I used, but not all, but I haven't been able to expand the data set. I didn't have time to expand it fully to everything they tariffed, but they tariffed washing machines and dryers and so on, and then steel. So these are the main categories I have, but they did much more when it comes to Chinese imports. And what we saw was kind of interesting that, so if you take a few items, specific items, washing machine, actually, prices went up dramatically, by 50% right after the tariffs, but eventually they came down. And another thing that was positive that we saw is that some of these, so the whole point was Whirlpool is an American company, we're trying to protect those jobs. Samsung and LG actually opened a couple of factories in the US. They brought about a couple of thousand jobs. Again, not huge number, but those are the kind, those are kind of what we looked at, and I'm kind of wanting to go more detailed because I haven't had a chance, because the election just happened and and it was the holiday season, so running this model has been a little challenging now. But we want to actually extend it more to more products as to what they did during the first Trump administration and see how it percolates in the economy to kind of forecast a little bit better.
Yeah, you just had 4 years to think about this.
Yeah. No, I have time. Now I have time. Now I got time. Yes. Yeah, but good question. Any more questions? Yes.
Trump was in LA recently. It was suggested at the town hall that perhaps he doesn't put tariffs on any imported building goods and supplies.
I did read that.
And he thought that sounded like a good idea, which was kind of surprising too.
Well, I mean, but remember, and Trump is very transactional, right? So you guys, and I'm not even sure. I mean, so I won't even be surprised if he actually goes item by item about what gets tariff and what doesn't. I mean, even in Canada and against China and against Canada and Mexico, I'm not even sure those Canada and Mexico tariffs are going through, but if they did, it'll probably be a negotiating tactic like it did last weekend against Colombia, and then it got taken back. So again, no one knows. It's kind of hard. Take this with a huge grain of salt, right? I'm guessing here for a lot of these things. But no, I mean, I wouldn't be surprised if it's product by product rather than just a blanket, you know. So yeah, no, I mean, who knows, right? Oh yeah. So, but no, yeah, I mean, that's why we're trying to gather. We have this huge data set that we're trying to expand with product level. And take lessons from the first Trump administration, because the interesting part is when the first Trump administration imposed tariffs, you didn't see this huge inflation spike. We didn't have inflation, right? Now, part of it is because there were still very small amount of imports from China. It's not a blanket 10% on everything that we import, which is about $3 trillion, right? So it's not that. But certainly the economic models got challenged a little bit from the fact that we should have seen a bigger increase in inflation, but we didn't. So we're trying to work and figure out why that was the case, right? And I mean, and again, some of it may be that and now it's going to sound very jargon and very nerdy, but the elasticity, the response of prices to tariffs and imports may be lower than what the economists always assume. Maybe that has changed over the years, right? So we're looking into this. I don't have an exact answer, but oh, yeah. I mean, again, no one knows, right? So I took a shot of thinking what would be more likely to happen, but any more questions? I answered everything. Oh, gosh. Excellent. Well, thank you so much. Thank you. Appreciate it.
Thank you, Mira. As always, I'm cautiously optimistic. Now, what would the effect be if we got the Rolling Stones back out on tour and show those Swifties?
I know, right?
So, thank you again. Mira does this out of the goodness of her heart. So every year she looks forward to it, and so I really appreciate her being here, and I know you guys liked her presentation, so we'll try to keep it up. Great day. Thank you all. It was a great show up, and I'm looking forward to getting to know all the Gregory clients in the next few months or months of the year. Any closing remarks?
No, I hope you all enjoyed this. I've had the opportunity to hear her speak, and I really...
Well, thank you. Thank you so much. I appreciate it.
Just a quick thank you. My sister, Susan, helps us with this event every year, puts it all together for us. And of course, Terry and Angel, I couldn't do it without them either. So now I've got Kate too. Yeah. So again, thank you. We appreciate you so much, and have a safe drive home.